Hi everyone, Stuart here again. Welcome to theproptrade.com and our monthly analysis of the non-farm payroll data. Very much in focus. Very much, many are arguing this is very much Trump data now. Remember, we've had the soft data falling off a cliff. Sentiment data, that is, consumer sentiment, and the hard data itself is very mixed because we obviously a lot of imports have front run the tariffs. Tariffs starting to bite 145% tariffs on imports from China. That's again, imports from China have fallen off a cliff. With some notes on that from Apple last night. We had Amazon reporting last night. Stocks actually closed positively yesterday. Nasdaq was up. Quick checks his notes quickly, and Nasdaq was up. Well, I've lost one. Well, yeah, 1.32%. The Dow was 0.2 of 1%, and the more important S&P 500 regained 5,600 on close last night. So all eyes this morning has been across the pond in Europe, looking at PMI and CPI data. So PMI or PPI data earlier from Australia was hotter. Retail sales was weaker. You've seen this, this continued rhetoric of, wherever we pick the data. I've left the Indian data on here. I normally take that off, but you can see here PMI's also weaker in India this more than expected, better than last month, but weaker than expected. PMIs in Europe, Italy, France, Germany, actually better than expected. As you can see here, remain in a contraction zone. So we had the main manufacturing PMIs out, not the main, but the US ones yesterday, which were better than expected, but again, remain in contraction mode. So manufacturing globally under pressure. That's why we've got chatter about a global recession. Obviously, the much more significant services numbers as far as sort of global demand and global supplies to come, but you can see the story developing, and this worry about inflation sort of ticking back up. The Fed keeps saying it's only going to be temporary. We'll see what this hard data around the jobs looks like in a few minutes. But CPI in Europe, as you can see here, also hotter than expected. 2.7% for the key core year-on-year number. The monthly number was in line at 1%, and the headline 2%. Not moving, but the core number ticking up in Europe. What many traders only trade sometimes. I know one person actually. I'm saying many. I only know one person actually only trades the non-farm payroll data. Seems a bit crazy to me, but I'm not sure he still does it, to be honest. But anyway, I'm sure he's trading more than that. But anyway, non-farm payroll data in about 10 minutes time. Earnings. The Fed obviously clearly concentrating on this unemployment number at 4.2%. I like to look at this wider measure of unemployment, the U6 rate, back close to 8% now at 7.9%. So we'll see what that looks like. What's the participation rate like? How's the trade announcements, the implication of the trade tariffs been affecting things? The headline number around about 135,000, 138,000 on the Bloomberg. Sorry, I think it's 100. Anyway, Reuters, Bloomberg, the two major data providers. One's reading 138, the other one reading 135 is the consensus. Quite a widespread again, as normal. Some well under 100,000. Some analysts on Wall Street. Others holding up around the 200,000 level. So spread, we got this average around about 138. If we actually look at the average here, we just go back to the Forex Factory calendar. You can see a nice little the charts we look at. You can see it's holding up. As we've been saying, consistently, as the markets have been saying, or the bulls have been saying, the jobs holding up consistently. We had a bit of an outlier here because of the storm, those two hurricanes back in November. But generally, anything over 150,000 is positive. Obviously, the average has come down significantly from where we were, over 225,000. That's come down, but it's still, a relatively vibrant economy. The chatter about impending recession is really, held within, the sphere of, the CNNs and the Bloomberg TVs and the CNBC TVs. Trump appeals directly to Main Street. He's trying to move Main Street, but the big risk is obviously Main Street. They voted him in because inflation was high and persistent, and it was that they remembered, and really people got hit in the pockets under Biden. And that's what people are still suffering from. And if prices are going to start to go back up, that's has obviously hit his ratings recently as well. But on the flip side, they argue, gasoline has come down very, very significantly. Massive drivers, obviously, in the Americans. We are heading into the key driving season as well in the United States. So the price of gasoline has come down significantly. And continues to fall on the markets as well. So again, in people's pockets, it's there's some upside, but the stuff they're buying from abroad, that's made abroad, particularly obviously from China, and it's satellite countries in Asia as well. Now Vietnam's been hit quite significantly as well. India's got hit, but there's talk of trade deals with India imminently, and China and Japan. So it's all in the mix. This is the hard data though. But again, it'd be difficult to analyze just on the headline number where we are with regard to the impact of the tariffs, because it's obviously 2nd of April is when they came in. They got delayed again. They were brought in earlier against its near neighbors, Mexico and China and Canada. Both have retorted and resorted to their own tariffs as well. Europe's very much in the crosshairs. The UK minimum 10% at the moment. Seems to be getting away with things here in the UK, but how long that will last, who knows? But remember, certainly from the UK's point of view, it's a massive. There's not a great deal of imbalance in the trade for goods. It's really the financial services is where UK and the US exchange favors. So 138,000, 135,000 expected. Anything over 100,000 is positive. It's looking for it's still replacement levels. Anything over sort of 200,000 again today will be deemed as a very strong jobs market, and the administration, Lutnick and whoever's getting wheeled out today to speak to the press afterwards, will be cock a hoop on that. But the devil will be in the detail as ever. Participation rate. Let's just go back to our calendar. It's got more detail on it. Participation rate. This manufacturing payrolls. Remember, it jumped 10,000 in his first reading after Trump had been inaugurated. It was a disappointing 1,000 last time, and a negative 5,000 expected today. So see what that's like. See what these participation numbers are like, and the average hourly earnings 3.9% and 0.3 of 1% for a monthly basis. So again, money in people's pockets in the US. They're still talking about getting this tax deal through a very benign Congress. Obviously, they're in complete control, the Republicans and the Trump administration. So let's see what it looks like in 3 minutes time. So a quick look at the markets before the data comes in. Dollar's been relatively weak this morning. It's the yen, actually. Let's show the yen. We were long this last night. Hit our target. We're out of that very quickly this morning. Well, we got in here 9-10 o'clock last night my time, and it hit target at 1 o'clock, so we're out of that one quite nicely. But let's just look at the others. So you can see dollar coming back this morning, but weaker there against the yen. So Aussie holding up as well. So we've got a weaker dollar. Dollar CAD 138.13. So bouncing again. Buyers at this 138 level. We were short this yesterday. We got stopped out on that one. Yesterday as we rallied up. Swissy 82.44. We were long this, and that was looking quite good this morning. That's actually been stopped out as well. Ahead of non-farm payroll, so that's a losing one from last night. Kiwi having a go at 60 again, so 59.40, 60. Oh, sorry, not having a go at 60. It was at 59. Having a go at 59.50, I should say. 60 still a long way to the upside, but we saw buyers for the Kiwi as we went down to 50, up 59. So dollar, let's say, weakening today across the board. Euro 113.35 and sterling 132.88, having another go to hold 132. We just got to the daily time frame here on sterling. As not another go, but we're holding that key 132 level is what I was trying to say properly. Where our big support is here, you see on the 20-day moving average. So a couple of down days, and for the dollar, sorry, a couple of positive days for dollar, and it's a bit weaker this morning ahead of this key data. Oops, sorry, you still got my great big head. Sorry, let's make the charts a bit bigger. There we are. As ever, guys, is there anything you want to look at in particular? Let me know. We've got a minute, so let's have a quick look at where Bitcoin is this morning. It's very positive. This 96,700, sort of at the top end of our range. A strong day yesterday, breaking out. That's nice. That would have added some buyers as there. We'll come back to this once the data's out. Oil remains weak. Energies. Oil remains weak, under $59 this morning, 58.70, and gold 2,360 at the moment, having had 3 down days into a 20-day moving average. We're holding now. We bounced off there at the moment. So let's have a look what the markets are taking from the data, which should be out now. I'm not still a minute to go. So this is the 5-minute chart, guys, for the euro. Euro diving as the data breaks. So I'll say diving, it's an immediate reaction to the downside. So far today we've been positive. This is the start of the day. Our low of the day was down here at 112.75. We've topped out at 113.55. So that's our upside target, 113.50 area. See there what's happened. And so far, let's see how this pans out. It's dived to its 200 period moving average here on the 5-minute chart. So if this holds, we could see some more resistance. A move back up and back over the 50 period there. But let's see how this comes. So let's have a look at the data. 177,000, so better than expected, but interestingly, quite a significant, this is not a surprise here, a significant revision lower for last month's numbers. Remember, the revisions can be quite key. So 185,000 for April from 228,000, and the headline 177,000 is the number, some 40,000 better than expected, around the 135,000 level. However, that could get revised lower as well, as we've seen it on this month as well. Average hourly earnings weaker as well at 0.2% from 0.3 that was expected. Let's have a look at our calendar because it'll fill in all the blanks much better than the Forex Factory one does. But it doesn't do it automatically, so we have to manually update it, and then I have to scroll through down to it. So let's have a look what it is telling me, or what my interpretation of what this data is telling me, because that's all it is, guys. It's just my particular thoughts on what's going on. So earnings stayed steady on an annualized basis. That's, it's rounded up. The key one is that monthly one at 0.21%. Average weekly also in line. That's actually been moved up a tad yet, so that's nothing to get too excited about. Government payrolls hanging on at 10,000. Remember the Doge trying to slash jobs. That's been revised down as well, so that's relatively positive. Another negative tick for manufacturing payrolls, a fall of 1,000. It was expected to be worse than that. This is interesting as well, a revision higher to 3,000 from 1,000 last month. Remember, we had that 10,000 the previous month. Non-farm payrolls, the big headline, 177,000, so it's better than expected, although the revision previous month has moved down quite significantly, much more significantly. In fact, it's about the same, isn't it, what I'm talking about? So that's 15 and 28, that's 45, that's about 40, yeah, it's about similar. So we could see a revision lower next month as well for this May number, but 177 still 40,000 better than expected. Participation rates has actually ticked up, which is also quite interesting. And private payrolls which is what the new administration are trying to take a kick on. Again, revised down by nearly 40,000 from last month, so that's quite a significant hang as well. But 176,000 better than the 124,000 that was expected. So again, another 40,000 plus better than expected. Interestingly, U6 has actually come down one tick. So although the headline unemployment rate remains at 4.2%, rounded up, the wider measure has actually come down, so that's a positive tick, I would say. So overall, that's got a lot for the administration to sing about. Really, we saw why we had that move down in the euro from this 113.33, all the threes, into the 200 period moving average here on the 1 minute time frame to test the key 113 area. I think that's where that stop loss is. I was just above there. It's not 113, but we've tested 113, but we still hold that at the moment. 113.13 is where we trade for the euro. So that's hanging on to that in this immediate aftermath of the data. See what some of my news feeds as well. See what they've got to say. Not a great deal, to be honest. Yields are up a tick. The 10-year at 425.78, so 425 for the 10-year yield. The more sensitive 3-year yield at 374.36. So again, it's it's a mixed bag, and there's both data. There's for both bulls and bears as ever. Well, not as ever, but typically there's both sides of the argument could be had on that one. If we look at how the stock markets reacted, so generally the dollar having had a weak morning, as you can see here, this 5-minute chart. So here's the start of today. So having had a weak morning, euro moving up, rippling up. We've broken down on the big data into the 200 there on that 5-minute time frame. We should go a bit shorter on the 15-minute. You see it's nice, steady, still and up. Topped out, got overstretched, and we're moving down. So down rate 15. So and move down into the under the 113 area for this to move lower for euro. Dollar. We'll just leave that one there. We'll just look at how the stock markets have reacted. They should have equally moved higher. There we are. Stock markets tick up. That's the Nasdaq 100 on the 15-minute chart. Immediate reactions positive for stocks, positive for the dollar, and yields higher as well. So Treasury's weaker, yields up, stocks up, and the dollar up, which is a bit of a conundrum. But anyway, we've the stock markets continues to run higher. The break here on Wednesday over the 50-day moving average of the Nasdaq 100 was very positive. The main move was here from the 24th as we went over the 20-day moving average on a big candle, and similarly we're moving up and into these key fib areas. So there you can see on the S&P 500 now having tested the significant 61.8 fib level yesterday. We are currently trading above it as well. So, but you saw how the candle finished yesterday. Relatively minor gains on the S&P ahead of the big tech companies, Amazon and Apple reporting their data. Dow continues to move higher through its 50 fib level, but still quite shy of its 61.8 fib level, but approaching its 50-day moving average to the upside, even though we've had this death cross that was mentioned in the middle of the month. Markets tend to bounce up because it's so lagging the death cross, but also in the longer term, we could still end up moving down. That's interesting. Again, the stocks continue to move up and the dollar continues to move to the upside as well. Go back to the 5-minute. Yields continue to move up. So we've got a bit of divergence in this second 5-minute candle. So, but overall, the dollar's come back a bit. but the euro, technically, we've obviously had some buyers here at this on the short-term basis at this 200 period at 113.10. So we didn't want to go under 113. There's 113 further down there immediately, but we still, you see here, we still remain relatively negative in this hour into the main data as we're under the 50 period and the 20 period. So a break back over here at 113.36 if we're going to test the day's highs. Technically, it's suggesting that may not happen, given that our high was put in here at 10 to 11. Then our next high was lower at 12.35. So lower highs, lower lows. Then we ticked up and then moved down. That's our support area. So we'll see. We need to break here if we're going to take this. This still remains relatively negative to me. Euro dollar on a short-term basis, going into the live market open in a little over an hour or so. So jobs again, quite a significant move, 177,000 compared to market expectations of 135,000. So it's positive, but don't just read those headline numbers. Look at the revisions, which are all quite negative, guys. Last month revised down from 228,000 to 185,000. Private payrolls revised down from 209,000 to 170,000. This month's initial numbers on both of the non-farm and the private payrolls here are about that 40,000 better than expected, but that could mean revisions to come as we move into the summer season going forward. I've nothing to really move with the work week. Earnings have slipped a little bit, but it's only one ticket, but it is, it hasn't moved up. And the monthly numbers also slipped lower. So those a bit on the negative side, but that's been countered by the positivity of the headline. But, the drill down data is actually perhaps more biased negatively than positively. Now I've looked at it again. The only fly in the ointment, or the good fly in the ointment, if you like, is the fact that manufacturing payrolls only fell by 1,000, and that's what they've been focusing on with this sort of repatriation of American manufacturing jobs, or creation of new manufacturing jobs. Unemployment rate fell, the wider one, and the standard remained steady. So unemployment hasn't moved up, but more or less just above the 4%, close to full employment. So that's positive. That's positive. That's positive. That's positive. That's negative, and that's negative. So mixed bag, and obviously these revisions are negative as well. So immediately we saw the dollar improved, stocks rallied, and yields moved up. It doesn't really change the dial for the Fed. The Fed is still going to. This is the hard data rather than sentiment data. Doesn't really change the dial for the Fed. The inflation data. If we just go back to Europe this morning, the inflation data out of Europe is hotter. It was hotter. The PMIs remain miserable. So see what obviously US CPI data looks like in a couple of weeks. The PCE number yesterday, again, a mixed bag, wasn't it, when we were looking at it yesterday? And the ISMs are better than expected, but still remain in contraction for manufacturing. The key services numbers coming next week. So overall, it continues to confuse, and the tariff impact is starting to sort of seep through some of this data, but the impact is perhaps not as negative as many have said. But again, only time will tell. So where are we? So euros recovered the initial drop. So the detail that I've just been focusing on, perhaps others have had another look at. So this might look to go long again if we can break that 50 and 20 moving average. Doesn't seem to want to. So we've had a moved down, a bounce back up, and now stalling around this level. So you can see we're at a key pivot area here from these 5-minute charts at 113.30, playing out through here. So you can see our resistance, 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 support, support, and will it hold? We'll see going forward. But so here, technically, the lagging 20-50 moving average looking quite negative. 200 supporting here on the 5-minute. Anything else, guys, you want to have a look at, or any other assets you want to have a look at? Obviously, do let me know, and we'll stick it in the box. So let's just go back to the other assets as well. So crypto, Billy Bitcoin, 96,900. So closing in on that 97,000. In fact, we've had a spike. I didn't see that. We have actually been over 97,000 yesterday morning. And moving now, let's just move up to the daily time frame. So this remains, as I've been saying all week, very positive. And we were talking about yesterday's positive close over that key fib level. Well stuck now in over this 92,000 level. This previous fib level, this key 61.8 fib level of the last big leg down from the all-time high at 109,000 here. On inauguration day to this worry about the crypto strategic reserve down here at the beginning of March and the beginning of April, where we went to 75,000. Here we are, $20,000 later at 96,000 and looking quite strong and positive. The cross of the 20 period moving average, as we said earlier in the week, above the 200-day moving average is another positive sign. And as we've said all along, the middle of our moving averages, the 9-period EMA, has provided a nice little support area, and we've even been above our shorter, faster, as we move so quickly, our shorter moving 5-period moving average. So strong day yesterday, great significant day, breaking the 61.8 key golden ratio fib. So that does bring in 96,000, which we breached yesterday. 97,000 we're banging on the door of as I speak, and obviously that then leaves us just $3,000 shy of the magic 100,000 level, and all-time highs at 109,000, which I'm sure you're all aware of, so I don't need to repeat that. So Bitcoin, Billy old Bitcoin remains bid, my friends. So careful shorting this, obviously, unless you know better than I do. But technically, that remains nicely to the upside. Of breach and break back below 92,000 would upset me. But apart from that, we're long Bitcoin. I'm not going to look at, unless anybody wants to look at some other cryptos, I'll go through the others, because I'm going to be back on and I need to get some lunch before our next webinar at 2:30. Oil, we had a significant drawdown, as you saw on Wednesday, in the inventories in the oil market, and Monday, Tuesday, Wednesday, we had these three black dove. We saw the creation of this three black crow candle position. We've been highlighting the resistance we'd had with the fib level here at $64. The 20-day period moving average also played out. And so for 1, 2, 3, 4, 5, 6, 7 days, we banged into the 20-day moving average, but we were held up by the next support level, which is our fib level, until Tuesday, on Monday, when we had a big down day. And then Tuesday, we breached that and went lower again here on Wednesday. Yesterday, we pushed under the $58 for quite a lot of the day, actually. If we just look at the hourly chart here, these are $58 levels. So for most of the day yesterday, so here from the start of the European session at 7 o'clock to the start of the US session around about 2 o'clock, we were under that key $58 level $58 level, and then recovered into the close of the the American session, then topped out this morning in Asia, but we're down again today. So although we're up short term, the daily time frame still remains a bit of a laggard. So again, clearly, like we saw last time, not as significant as we saw there on the 9th of April, but some big buyers at $58 for US crude WTI US oil bouncing off $58 again yesterday, but still remains very weak. The 38.2 fib level, which provided support here for the second half of April, and the 20-day moving average are now coming to coalesce around about the $62 level. So just like 92,000 was a key upside target for Bitcoin in the crypto market, $62 to the upside on a daily basis, a daily time frame, is key for oil to move higher. At the moment, it remains anchored even under $60 a barrel. So oil remains weak until the story of global recession starts to dim, or we get some physical movement in some of the geopolitical things that obviously play into the oil market all the time. The bombings out of Yemen, the bombings into Yemen, the Russia-Ukraine situation, the Iranian situation, that's very much on the agenda. Obviously, we saw the national Waltz finally falling on his sword yesterday. The national Waltz, the guy that was responsible for that breach of the chat group. Why it's taken so long, I don't know. But anyway, nothing surprising in the chaos of the Trump administration. But anyway, oil, yeah, so still downside, $62 to the upside for a break, $60 first, obviously $58 is where we've got some buyers. Indexes we had a look at, and let's have a look at gold in a bit more detail, and silver if anybody's interested. I don't know, he said they're trading silver. So big move yesterday for gold. I was threatening to go short. My strategy was threatening to go short early in the week. We didn't take it. It didn't actually trigger last night either, because it's probably ran out of steam as far as my or the impetus might have run out of steam on my strategy. But the 21 EMA here hanging on, although we are now significantly below that 3,300 level from the first breach here we saw on Wednesday. So down again today. The support area we've bounced from today for gold. It's got the hourly chart. We've bounced from this is low here at 3,200. So we went nearly $100 down to the 3,200 zone, and we're back to 3,250. So we've bounced $50 from yesterday's low. So quite a significant turnaround. But again, the higher time frame remained relatively negative. So we've had a glitch, not a glitch, but we've had a break of the 20-day moving average into close yesterday. We've moved higher this morning in Europe. We breached the 50-hour moving average, but it looks like a bit of a rolling, rounding top potentially forming there until if this 20 crosses from below to above the 50, the red line crosses the blue line to the upside, that'd be positive. If it manages to turn down, this moves down in this hour again, we could be down to test the 3,200 level again. Fridays, remember, as I say, can be quite significant movers for gold. Well, that's actually going to happen today or not. Again, only time will tell until we get into the close of the day. The 4-hour chart remains relatively negative. We got this rounding bottom, which is negative as well. So again, 4-hour perhaps more significant. The 20-period moving average hasn't been breached, and it hasn't been breached on this move lower. So we consolidated here on the 4-hour round about that fib level as the flattening of the moving averages kept us contained here in consolidation mode, quite an extended consolidation mode. And then for a 4-hour trade, it was that significant candle there into close at the end of the month, which took us lower and gained the momentum into the 3,200 level, which we've obviously found some buyers there and we've bounced off. So the 4-hour trader is still short gold on this strategy, but we are, you might have gone against the trend on this low bought. It had some buyers down here at just above the 3,000 or 3,200 level. It wasn't actually hit if you had it just right on that number, but and we've ran to our first resistance, which is the 20 period moving average. Is that going to hold into close of the week? Well, again, only time will tell. We'll find out. But if it does, we've got two big resistances to the upside, 3,300 and a 50 period moving average here for 4-hour traders. But that's looking possibly positive. We shall see. That candle complete. I started at 7, completed at 11. This one started at 11 and will not complete for a couple of an hour or so yet. So see, but it doesn't look like it's going to breach that with any significant oomph, does it? You can see what I'm saying by oomph. It's not a big fat body. See what happened here overnight? Nothing really yesterday. So it remains quite weak on the 4-hour and the daily, as we saw. Yet to breach the 20-day moving average, but rolled over from this consolidation, this support at the fib level into the next fib level here at what was that last leg up, the 50 level. So is that going to support hold as well? That 3,200 is the next big support level. Bang, as we said, halfway between the 50 and the 61.8. So next downside target from big fib levels is the 3165, where the 61.8 fib level sits for gold traders, my friends. Quick glass of water. So let's go back to the Forex market, see if how they we're now 25 minutes post non-farm payrolls. Let's go back to the euro. That's what the euro we were looking at, weren't we? On the 5-minute time frame, these short time frames. So down, up, and then down again the last 10 minutes. So clearly, we're now stuck between the 20 and the 50. You want to be safe. The 50 period moving average here on the short-term basis at 13.37, and support is here at 13.10. So 27 pip range we're stuck in at the moment. Things might change, obviously, as the cash market opens in the United States later on, but there's not a great, obviously, this is the main data of the day. And as you can see, it wasn't, it wasn't that significant move, was it? I mean, the range these days is much milder. So really, we were at 113.33 and we went as low as 113.05. So now you're 30 pip range on the immediate announcement, which was better than expected, the headline, but the detail was actually quite weak. The revisions had revised lower. Some of the other bits of it were okay. So we're sort of back where we were really with a bit of a weaker dollar, but dollar's come back a bit on the non-farm payroll, but still euro is, if we've got the daily time frame or even the 4-hour time frame, euro is still up for the day, isn't it? So these are lows this morning, and we're still up for the day on the 4-hour time frame for the euro. And the daily candle will still be green at the moment as well. There we are. So we're still up for the day. But if you're only trading the 5-minute time frame, you're not really interested in that, are you? You're interested in trying to squeeze some pips out of this range. So there's your range. It's very, very clear there on the euro. If you want to do the same thing, somebody just asked me about doing the same thing on gold. So let's just have a look at the same thing on the gold market. So so again, just look at this. If you're an intraday trader on the 1-minute or 5-minute time frame, the weakening dollar has let gold move up here on the 5-minute time frame. We got higher lows, trending higher nicely. We got higher highs here. We got the 50 period moving average providing support for most of the Asian and European session. The main data, excuse me, came out. Where are we? What's 30? That's the main data came out there. We'd already moved lower. So main data came out there, and then we bounced up. So if we're going to move at we're going to get some more weaker dollar, we need to move back over 32.59.70 is the first line in the sand for gold bulls, and then through 32.61. So 32.60 really is the big line in the sand going forward into the rest of the day. You can see how that pivot area, that's that 32.60 watt or 60. Let's put it on. Let's make it a round number. Let's not get too overzealous about the actual number. So let's call it 32.61 then. Is where the 50 period moving average on the 5-minute time frame is. You can see it's a resistance area that we've ran into umpteen times today. So once, twice, 3 times, 4 times, 5 times went through it, came through it the 6th time. So that's our resistance to the upside. 32.60, a break of that would take us higher. The day's low was all the way back here, wasn't it? as we start the day. So our day low in the Asian sector is all the way back here at 32.27. That looks a long way away to get to. So where's our first resistance? Where's our first support? Well, it's at 5 on this 5-minute chart. It's our 200 period moving average there at 32.49, just below the psychological 32.50, which is where, you know, $1 above where we are at the moment, or $1 below. And again, you can see how that 32.50, the round number, has been in play today, and it, as ever, these. So key area where we are now, a break, significant break of there will definitely test that 200 period. The RSI may have to move into oversold or spike down again lower for some buys to come back, but the, you know, the MACD here would have been short there. There we go, absolute class combination. Then you see that the moving averages have crossed there. We've gone under. In fact, that went earlier. So here, this strategy, you can see that playing out really nicely there. The MACD and the signal line crossing there at 12.55. The moving averages, I know everybody hates the moving averages because they're slow and old-fashioned, but, you know, they work, friends. They work. Don't knock it if you haven't tried it. And trust me, they still work well enough. So that would have been short there from 1 o'clock. 12.55 was the first heads up. Well, the heads up was the one before that, having been long there nicely. Stop loss up here somewhere to start off with and down. And then if you want the risk of keeping that open on the non-farm payroll, you know, keep the stop loss, you know, fairly, you know, the high of the day, really. I mean, you could have had it up there, the turn, if you wanted to be, not to get too scary, but the trend was down. It went down initially on the data. It bounced a wee bit, but we didn't come back. So again, now having gone down again into this 200 area, you could have nicely taken your profits down there at that 32.58.49 area. So it's like magic, isn't it? When it works. When it doesn't, it's the most frustrating thing in the world. But yeah, it's all about risk and money management, my friends. Join me in half an hour. I'm going to wrap this up now because I need to go and get some lunch and a cup of tea and a bit of coffee. So join me in half an hour. We're going to talk about the most important thing if you want to be a successful trader, risk and money management. You combine that with trading psychology, which we're going to talk about next week, getting your mind in the right place. That's absolutely fundamental as well. They're the three big pillars of, you know, what you call risk and money management. They are different, but we talk about them both. We're going to talk about both of them today, risk and money management. But risk and money management, risk management, money management, trading psychology, three major pillars of success in trading, certainly if you want to do it for any length of time. See you in 30 minutes, my friends. Join us either on our X channel or our Bloomberg, what am I talking about? Our YouTube channel, and we'll be live for that. So see you all later. If you haven't got an account with us, why not? It's the obvious thing to say to you all. Just come and join us. Quick, before I go, we'll have a look at next week briefly. Actually, let's do it on, it probably might be easier on apply settings. There we are. On Forex Factor because it compresses a bit quicker. So inflation and services PMIs. We're into the second or the first full trading week of May. May is traditionally quite a week. Sell in May and go away is the old caveat. That's not perhaps as relevant as it used to be. We got a bank holiday in Japan and London on Monday for the early spring bank holiday. So two of the major centres, Tokyo and London, will be closed. Lack of liquidity on Monday. Japan celebrating the start of the summer. So ISM services will be the big number I'll see you for on Monday. Remember, services much more significant to the overall economy of any country than manufacturing these days, even though the sentiment around manufacturing is very symbolic. Kiwi unemployment numbers. We've got elections in Australia coming up this weekend as well. We got the Fed statement on Wednesday. That'll be fun later on Wednesday. What can they say? Thursday, May the 8th, is the 80th anniversary of Victory in Europe Day. Victory over the fascists the Nazi fascists by the Allied forces. So the French have got a bank holiday. We haven't got a bank holiday in the UK because we've already had Monday off. But we've got the Bank of England. Again, what can they say? Expected to cut rates on Friday. It'd be interesting to see what this vote looks like, because there's quite a divided, quite a split, some noises within the Bank of England down at Leadenhall Street. So 25 basis points to come from the Bank of England, pulling it below the Fed. So Fed will be top of the tree still. It's getting right at the president's nose, isn't it? Weekly claims as usual also on Thursday, and Friday we've got Canadian jobs, first week after the reinsurgence of Mark Carney as Prime Minister there. So quite a significant week after today's non-farm payroll. But as I say, join me in 25 minutes now for our next webinar on risk and money management. Stay safe, my friends. May the pips be with you. And if you're not with us, oh, come on. It's, it's next to nothing to get a very high level of leveraged account. And, you've got to be successful with prop trading, and us at the proptrade.com, you've got to trade in a systematic, consistent way. And you can't be risking ridiculous amounts of money. So you've got to be, got to prove to yourself, prove to us that you can be a successful trader. So here, whatever type of challenge you want, 8%, but the maximum loss 10%. So that's what it's all about. Focus on the losses. The profits will come, guys. If you keep your losses small, the profits will come over time, and there's no rush. Although it says, minimum trade day 3 days, people come on, can I do it in 1 day? Well, you can, but what's the rush? Do it properly. Stay in business. Get yourself funded and get yourself some real money paid by us to you for being successful with your trading. Once you've proved to us that you can do it in a sort of managed way, because that's what all prop firms are looking for, and particularly us here at the proptrade.com. We want you to do it properly. No massive risk, because you just you're hindering yourself. You're going to blow it up. You might get away with it once, risking whatever. But anyway, more on that from 2:30. Take care. I'll see you in 25 minutes. All the best, everyone. Bye-bye.